Hello and welcome to MF Corner. I'm Sumaira Abidi, and today on the show we're going to talk about investing in small cap funds. Is it an opportunity or an adversity? Joining in will be Feroze Azeez, Deputy CEO of Anand Rathi Wealth Ltd. And in a bit, we'll also talk about whether the time is right to begin or increase your exposure to passive investing with Harshvardhan Roongta of Roongta Securities. But first, the focus on small cap funds. Feroze Azeez, Deputy CEO of Anand Rathi Wealth Ltd. joins in. Hi Feroze, good afternoon. So what about small cap funds? We've spoken so much about the larger caps, the mid caps. A lot of people are scared of small cap funds, and rightly so, given that the rise and fall is equally sharp. What's the outlook currently on small cap funds? Should it figure in somebody's portfolio?
Sumaira, I think small cap is less understood, and you rightly pointed out there's so much spoken on large caps and mid caps. Small cap, before we even conclude whether it's a good opportunity or something which you should stay away from, you have to get some principles right before you pick some funds. So I think there are 4 or 5 things which are very important. And that's what will help an individual decide whether he or she is meant to be buying a small cap fund at any point in time during the investment journey. And then comes the last question, whether today is the right time. I think it's very important to understand those 5 things. So first of it, let me begin by saying the small cap funds, the selection of the fund is going to be very critical, because the divergence, the best and the worst small cap funds every year have a difference of 40% return. So small cap might be a very generic category, but you see the dispersion of the returns in those 20-odd funds between the best and the worst is humongous, 40%. So it's not just about you choosing to get into small cap, but the last mile, choosing the right scheme is going to decide the fate of your investment.
You know, Feroze, the other thing is that when somebody asks for a rule of thumb between, how much should be an equity exposure in my portfolio or how much should be debt, they say, 100 minus your age. But is there a rule of thumb for, within equity, how much should be large cap, how much should be mid cap? And therefore, the question I'm getting to is how much should be the small cap exposure?
I think as far as I've spent about 2 decades in this industry, most advisors or most clients keep it very static and very judgmental in terms of objectively not evaluating this proportion. One model which has helped my clients and myself immensely is trying to find out the relative valuation between these 2-3 categories. So if the price to earning, which is a very commonly used valuation method for Nifty and mid cap and Nifty small cap is compared over long periods of time, the difference between the P's will help you determine which one should you be more gravitating towards. Let me put some numbers in perspective. Actually, the difference between Nifty P and Nifty small cap has been almost 38p. Nifty small cap has been 38p higher as an average between Nifty and this. Today the difference is only 22. So from a relative valuation standpoint, small caps are better placed than the historical higher valuations they command. So point I'm making is, Sumaira, I think you should not be static. You should not be very subjective. You should be very objective, and the method of that objectivity is the differential valuations between these categories. And today, if I have to be more specific of small cap, the difference in PE has been historically 38 and currently it is 22. That means small caps are not relatively as expensive as they are used to be.
So if I'm understanding you right, Feroze, what you're saying is that the time is right, therefore, to add on small cap funds?
Yes, definitely, after you've understood the risk return profile and of yours and the scheme in itself. Yes.
Okay, so the perception that small cap is generally riskier than large or mid cap peers, does that perception hold, or is there a class of investors small cap funds are better suited for? I mean, should there be some investors who are perhaps risk averse who should stick to large caps, and the more adventurous kinds can look at small caps?
See, I think, yes, definitely. Numbers at least suggest so. Risk, at least to our mind, has been very English-oriented. So let me put some numbers to give a person an idea how much more riskier are they than the large cap. So the risk measure for large cap over the last 3 years has been 20.7. So that means that the swing in the values of your NAVs are going to be reasonably large, 20. Small caps have a risk integer of 31.3. So that means they're almost 1.5 times more riskier than the large cap. So once you have a relative idea of how much more risk are you taking, then you get a sense whether you have the appetite to live through this uneven curve of growth.
Okay, but Feroze, there are some new risks which have come to the fore, right, over the last 2 months. And one, of course, that now what you want to check for every fund is whether or not your scheme can honor the redemptions. So for a small cap fund, which is a little riskier in nature anyway, and given, the volatility that we are seeing in the markets these days, is there such a fear, and is it a valid fear for a small cap scheme?
Yes, I think it's one of the most important risks which you're highlighting, Sumaira. That was one of my points. So let me go to the fourth point, which is liquidity. See, when you have small caps, it's a larger canvas for the fund manager. Unlike if it's a large cap fund, then you're more or less sticking in the top 100 companies in the country in terms of market cap. Small caps is a larger canvas and different sizes are there. So I think liquidity is very important. Liquidity can be understood by finding out 2-3 things about your fund. What is the benchmark? If it is Nifty Small Cap 100, it means that the liquidity will be lesser of a concern. Nifty Small Cap 250, if that is the benchmark of the fund you've chosen, the liquidity relatively will be lower in those bottom 250 stocks. So liquidity is an important concern, Sumaira. And how do you find out? You find out by identifying the benchmark which your scheme uses. If it's Nifty Small Cap 100, you're better poised. If it is Nifty Small Cap 250, the risk of liquidity is marginally more. But apart from this, fund managers are reasonably prudent and they're very sensible. So they keep some money in mid caps and large caps to provide for these redemptions if there is a large redemption pressure. So that's what you'll have to check. So liquidity is an important risk. If you're buying a scheme of small cap, identify what's the average market cap of that scheme. So Nifty Small Cap 100, the average market cap of each company there is about 3,800 crores. And Nifty Small Cap 250 has an average market cap of 3,200 odd crores. So understanding market cap and understanding how much is there in large and mid in the small cap scheme will help you identify how much liquidity risk are you carrying.
Okay, so Feroze, then what are your recommendations then in the small cap funds?
In the small cap fund, if I have to give you one recommendation, it will be Axis Small Cap Fund. Axis Small Cap Fund has a few things which we have checked at Anand Rathi. One is the fund manager has taken 7 right decisions to every 10 in the last 3 years. So it's very important to identify the fund manager's capability to smell businesses much before the market identifies them. So 7 out of 10 is a good ratio of stock picking capability. Second, the risk taken, the standard deviation of this fund is one of the least in the category, and it stands at 22 as against the category average of 24-25. So that's the second point. The third is, I think there is enough headroom in the stocks from a valuation standpoint to grow from here as well, apart from the past performance of the scheme. So this would be one of my recommendations. If you want another one quickly, HDFC Small Cap again has done something very similar to Axis Small Cap. So both could be chosen for 10% of your portfolio.
Okay, Feroze, I know you said that reduce your exposure to large cap funds, but given the way things have moved, and there is still some bit of uncertainty regarding how the global outlook, etc., is going to pan out. But there is a lot of money coming in from, global central banks. Therefore, in the large cap, mid cap space as well, I guess, you can't go wrong if you were to invest over there. Therefore, any schemes from the whole universe that you've picked and chosen?
See, we as a philosophy only stick to 8 schemes across all clients and ourselves. So there are 2 changes we're making just now. So Axis Blue Chip is a new addition to our model portfolio, and the DSP Mid Cap. These are the 2 schemes in the large cap and the mid cap category, which are new entrants in our model portfolio. For a large, deep research, it throws up that these could potentially, from a future standpoint, deliver better risk-adjusted returns. So Sumaira, these are the 2 other schemes, which apart from the 8, 2 of them are being exited, which is Nippon and L&T Mid Cap. Nippon Large Cap and L&T Mid Cap are an exit call, and these 2 schemes, which I just stated, are an entry into our model portfolio.
All right, Feroze, thanks much. We won't take up much more of your time. Thanks very much for joining in and for talking about the small cap space. So small cap funds can increase your allocation a little bit right now, 10% of your portfolio, to recommendations as well given. But do remember that, you have to invest with your eyes open. These are recommendations given by an independent expert and not those of CNBC TV 18. A quick break. On the other side, Harshvardhan Roonghta of Roonghta Securities joins in to talk about what should be the portfolio strategy as far as passive investing is concerned. Stay tuned. We'll be right back.